After tax, friends, let me now come to a few thoughts on investment planning. Tax planning via planning of investments, what I call. And here are some tax-friendly tips for planning your investments. Friends, many of us, we don't really live out of our investment income. We want investments to grow for posterity, for future. And therefore, we must think that if we are in the top tax bracket, why do we want to earn income every year, pay tax thereon, and after all, we are not even going to consume that income. We would just want to reinvest. And this is what happens when you have your schemes where you have choice of dividend or your normal income versus growth. Now, friends, for almost all high bracket taxpayers, growth instruments are the focus to look at. And my next couple of slides will talk about some of these smart strategies for tax saving in terms of tax planning via planning of investments. Now, I've tried to explain that in the first instance, your annual dividend income or your income, normal interest income, whatever you call, will attract your max tax of 30% if you are obviously about 10 or 15 lakhs with the surcharge and cess, depending on where you are. So starting from 31.2, it can go up to close to 43. Now, what is the advantage of growth? Say you have two schemes, one is a growth scheme, another is an income scheme. Obviously, when you go for growth, the advantage is tax deferral until redemption. Because until you don't redeem anything, until you don't get money, there is no question of paying any tax. Even that time, apart from the tax deferral, friends, you will pay lower tax on capital gains. Well, the arbitrage is there and the government is conscious about it, but they have to live with it. When it's normal income, it's dividend, interest, etc., it attracts the regular rates of tax. When it comes to capital gains, then friends, see the concessional rates that you can enjoy. Your equity products, and equity products need not necessarily mean risky, products where returns are not sure. You have products which are in a way packaged like debt, your arbitrage schemes, but which have the feature, and particularly on the tax front, they are featured or styled as equity products. A lot of people like this arbitrage funds, which have steady returns, but at the same time, a very tax-friendly rate of 10% on LTCG. And all that you need to hold for an LTCG is just 1 year. For your short term, say suppose you are not able to hold for 1 year, then you will still pay only 15% as against the normal tax, which can be 2 to 3 times. Friends, even in case of debt instruments, you don't have 10% concession. But here you get your 20% tax on your LTCG, long-term gains, but you have a very vital indexation benefit. So considering the indexation benefit after your 3-year term, your impact is going to be much less than your 20%. But in any case, when you opt for a growth instrument and invest in the same, friends, you enjoy the distinct advantage, one, of tax deferral, and second, of a lower rate of tax. Now, talking about this, friends, I am coming to a very interesting scheme. It's worth looking at, and that is for those who want, I'm talking of those middle class taxpayers who want to, use certain income, but at the lower rate of tax. And therefore, I have called these SWPs, they're ideal for earning fixed incomes but at lower tax. Now, how does this work, friends? Let me take you through this. Now, what are these systematic withdrawal plans? You invest a certain amount either in a lump sum or under a systematic investment plan SIP. You have any of these two options. And then from a particular point of time, you either under the scheme or with your own option, you make your suo motu systematic withdrawal plan. Now, what is the beauty or the tax efficiency or shelter of an SWP withdrawal? I'll have an example case study to show later, but take a look at this, friends. There is no tax on capital component because when you are withdrawing, there is capital and there is income. So there is no tax on the capital component. The income element is taxable as capital gains. Then you have the equity plan withdrawal after 1 year, which is treated as long-term capital gains. You know, if you go for those kind of products, case study will drive home this point, but let's first of all remember these basic Guru Mantras or rules. Then, friends, keep in mind what I mentioned earlier, that you have your annual long-term capital gain of up to rupees 1 lakh exempt under section 112A for all entities, and your LTCG over 1 lakh will be taxable, but only at 10% if it is an equity product. Now, friends, here is a case study to look at to support this proposition of earning fixed income at lower tax. Take a situation, I have invested 1 crore rupees, which is 1 lakh units of rupees 100 each, with an annual growth at 10% per annum. You know, it's a bit on the higher side, but to make it simple, you know, it could vary. You know, somebody would say, I may not get 10, okay, it may be 8. Somebody may say, I can go up to 12 or 15. But I have taken a very balanced average of 10. Now, after 1 year, friends, I have taken 1 year because I wanted to become LTCG. After 1 year in 2020, the unit value grows to 110. Now, you want that every year, you want 10 lakhs as a middle class taxpayer for your family's consumption. So what would you do? When you want these 10 lakhs, you would redeem certain units. The value per unit would be 110. So I would be required to redeem how many units? 9091, 9091 units. Now 9091 units at rupees 10 per unit will get me 90,910. Please understand this, because what is my income component? I am withdrawing 10 lakhs. Out of that 10 lakhs, you know, almost you can say 9 lakhs and 10,000 or 9 lakhs and 9,000 is something which is close to the, you can say the capital component. And there is 90,000, which is the long-term capital gains. Now, the long-term capital gains up to 1 lakh is exempt under section 112A, and there is no effective tax on annual cash flow. There is no effective tax on the annual cash flow. Please keep that in mind. So, what is the big advantage? If that 10 lakhs was earned as interest, say I had kept 1 crore in a private deposit at 10% and I had earned it as interest, I would have paid tax at 31.2%, 3 lakhs and 12,000. Here, I am getting the same annual cash flow of 10 lakhs, but as I mentioned, 9 lakhs and odd is capital component, around 1 lakh is the long-term capital gains, but under 112A, it is exempt. Well, friends, in the subsequent years, the pattern can change, but this is a very good strategic principle to look at. And now I come to the last topic. You know, this subject of tax and investment planning, as I said, is so wide. It's an ocean. And the deeper you dive in, friends, the more gems and jewels you'll get. But I would like to close today with perhaps that's what the last thing every one of us looks at, and that is retirement. It's a different thing that the Corona experience has given so many of us the experience of leading a retired life right now. But anyway, friends, these last 2-3 slides are on NPS. And I want to put this focus on NPS because in the last 2 years, in fact, in the last year and a half, some very important amendments have been made thanks to the then Finance Minister, Mr. Arun Jaitley, you know, who had a great passion for this. NPS is never so attractive ever before. NPS is something worth looking at. Now, we quickly need to recapitulate what are the salient features of NPS, particularly from the tax exemption or tax shelter point of view. One is the employer's annual contribution at 10%, and in case of the government servants, 14% of their basic salary. But then keep in mind, friends, the 2020 Finance Act has brought in this rider of 7.5 lakhs. You know, so beyond 7.5 lakhs, your employer's contribution would be taxed as a perquisite under Section 17. But up to 7.5 lakhs is exempt under AIFTP 2. Employees' contribution of 50,000 separately deductible, as you know, under AIFTP 1B. Your own withdrawal of your own contribution is exempt under 1012B if you make it in one or more installments up to 25%. This gives you a big liquidity comfort. And then, friends, 60%. This is where there is a huge, bonanza given to you of the amount payable on closure or exit is exempt under Section 12A, and only pension out of the balance 40% invested as annuity fund would be liable to tax, and the corpus amount, if it is received by you, obviously it's taxable, but if it's received by your nominee, you keep on the annuity in perpetuity, you can continue, would be exempt under 80 CCD 3. Now look at this case study, friends. This tax saving via NPS case study, I have taken an executive drawing annual salary of 55 lakhs, the employer's annual contribution at 10%, 5 lakhs and 50,000 exempt from tax, employees' contribution of 50,000 separately deductible, 25 years, presume that he's 25 years until retirement, investment of 1.50 crores, because 6 lakhs will be invested, 550 from the employer's contribution, 50,000 more, and 6 lakhs into 25 years would be 1 crore and 50 lakhs, a clear straight tax saving of 45 lakhs plus, 30% plus, depending on your slab. At 8% per annum, friends, because NPS has now, the options in its tiers to go in for a range of instruments. If at 8% you are putting in your money, your investment grows to 4.75 crores. So on retirement, 60% of this 2.85 crores can be withdrawn as exempt. Pension income of 1,25,000 is what you will be able to fetch, considering this 8%. So out of the balance corpus, 40% annuity corpus of 1.90 crores, if you get it at 8% per month, you will get a pension of 1,25,000. So friends, it really looks attractive because if you are prepared to wait until your nominee getting the 40%, virtually it's a completely exempt scenario except for your pension income.